Medtronic is the largest medical device maker by revenue and a Dividend Aristocrat with over 44 years of raising their dividend payment. Shares of Medtronic are trading at levels not seen in over 5 years, creating what I believe to be a potentially fantastic opportunity for long-term buy and hold investors. In today's video, I'm going to do a proper valuation and attempt to determine a fair value and buy price for this healthcare equipment giant. I'm Nick and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor and smash that like button and subscribe to keep up with future videos. This helps us out more than you could ever imagine in bringing you quality dividend investing content. We're in the middle of doing a series on the top stocks of 2023 for every sector in the market, and Medtronic was highlighted as one of the top 3 companies in our recent healthcare dividend stocks video, the top healthcare stocks for 2023. Now, I don't want to spend a lot of time rehashing what we featured in that video. Here, I want to take a bit of a deeper dive into the company and show you what I think is a good buy price for Medtronic. Please leave a comment down below on what your favorite healthcare stock is for the year 2023, and do you own Medtronic? I did want to follow up on one item that was raising some questions in that last video regarding the tax implications for American investors, being that Medtronic is technically considered an Irish company. Typically, American investors would be subject to Irish withholding tax. However, any resident of the United States or country that is considered a relevant territory is entitled to an exemption from this withholding. If you are a tax-paying resident of the U.S., you are exempt as long as you have a W-9 and a valid United States address on file with your broker, and you have confirmed with your broker that they can certify a valid United States address with a Form W-9. Now, if you have a trading account with a major brokerage, it's highly likely you've already been required to fill one of these forms out before you're even allowed to trade. But if you're unsure, simply check with your broker. You can send them the link I put in the description to make sure you are exempt from this withholding tax. And be sure to check on that link for the specifics on how this works, okay? Taxes aside, as a dividend investor, what stood out to me the most when I began looking at Medtronic is this historical yield chart. And I got this from Seeking Alpha. Seeking Alpha only shows data up until the Dividend acquisition in 2015, which is when the legal headquarters for the company was set up in Ireland. But since the acquisition, at no point were dividend investors able to get a starting yield for Medtronic above 3%. There was a brief moment in that short 2020 COVID crash where the yield briefly approached and came close to 3%. Now, this yield really started to run for Medtronic in September of 2021. The share price began to decline, and by September 22, the yield had crossed that 3% mark for the first time in the new combined company's history. And it's only continued to rise as shares of Medtronic had continued to decline. At the time of publishing, you can get shares at near 3.5% starting yield, while the stock has averaged right around a 2% yield in its trading history, again since the Dividend acquisition of 2015. Now, shares of Medtronic are down 30% year to date, explaining that dramatic jump in yield. And we aren't even sure if we're at a bottom here yet. Shares are currently at their 52-week low. Short-term issues exist with Medtronic. Growth has slowed. Revenue has not really grown much in the last 5 years. The COVID pandemic hurt their business and their growth in various ways, from supply chain issues to surgeries having to be put off during the height of the pandemic. And Medtronic released earnings a few weeks ago and cut the full year earnings guidance for 2023 due to concerns with foreign exchange rates. But despite the drop, check out these dividend grades from Seeking Alpha. These are relative to the healthcare sector, not the entire market, but these are really solid, right? And jumping over to Simply Safe Dividends, the Simply Safe Dividend safety score is the highest possible at 99. And the dividend makes up less than 50% of earnings and less than 65% of free cash flow. And it's not often you can buy into a Dividend Aristocrat at this sort of discount. They've been growing this dividend for 44 years, and in the last 5 years, the dividend has been growing at an 8% average annual rate. As a dividend investor, this looks like the best time to get into Medtronic that we've ever had. This is a well-diversified business focused on 4 main segments. You have the cardiovascular, medical, surgical, diabetes, and neuroscience. They have a robust pipeline of products to help drive their short, medium, and long-term growth and fully capitalize on their market. And one area I would like to see them improve is they should be buying back some of their shares when they're at this great of a discount. They issued a ton of shares in 2015 to fund the Covidien acquisition, and this seems like a good time as ever to bring them back down. Now, they do mention they repurchase shares in their investor handouts, but they are only doing so at a level to offset stock-based compensation. And I would like to see them do a better job here than just keeping it level. But as a dividend investor, I'm primarily buying this one because I expect it will continue to pay a growing dividend, and I can use it as a means to build up my own passive income. And that's where I put my own focus these days. Now, with that said, let's bring up the spreadsheet I have for valuation. Now, what I do is I look at several different valuation models because no one model is perfect. I take Graham's revised valuation, a dividend discount model, a discounted cash flow model, and then a couple relative valuations based off historical dividend yield, historical PE, and the average analyst price target. And then what I do is I take the average of these to determine a fair value, and then I can apply a margin of safety to come up with a buy price. So I put in the ticker MDT here, which gives us a share price of $76.70. Entering the dividend of $2.72 gives us our 3.55% yield. I also entered a forward PE of 14.6 and a forward earnings per share of $5.27. Now, first off, for Graham's revised valuation, I think this is becoming less useful as interest rates rise, but I'm still including it for now. I am assuming a growth rate of 5%. I think this is a reasonable growth rate going forward, and the current yield of a 20-year AAA bond is 4.9, and the higher these rates go, the lower these valuations are that we get from this model. So by Graham's revised evaluation, we're getting a fair value of $56.79. Next, let's look at the dividend discount model. This is also called the Gordon growth model. The historical 5-year annual growth rate is 8%, and their latest dividend increase back in May was also at 8%. Going forward, I am going to go a little more conservative and use a dividend growth rate of 6.5%. And with a 9% discount rate, we are given a fair value of $115.87. So from a dividends perspective, this is looking quite undervalued. Well, let's move along to a discounted cash flow valuation. I assumed a growth rate of 6.5% here as well, and a 3% perpetual growth rate, and a 9% discount rate. I entered in the current free cash flow, which is about $4.8 billion, and their outstanding shares are at $1.34 billion. This gives us an estimated fair value for the discount cash flow model at $72.03, and it's really just a few bucks under the current share price. And for the next valuation, we simply do a comparison to Medtronic's 5-year historical average yield, which is 2.18%. This is going on the assumption that things often revert back to the mean. Recall the historical average every year for the last 8 years. For this year, the average yield was around 2%. Now, what this valuation says is if Medtronic were yielding its typical normal yield today, it would be trading at $124.77. Now, it would have to come back up quite a ways to get there, but it was at and above this level just 16 short months ago. Okay, and let's also look at the PE mean reversion valuation. And this is simply calculating the current price would be for Medtronic if we'd used a historical 5-year PE, or if the PE reverted back to its mean. And the historical 5-year PE is 18.4, while its current is 14.4. And if Medtronic was trading at its usual mean, it would be priced at $96.97. Finally, I'm going to put in the average analyst price target, and Wall Street sees this stock higher 1 year from today, averaging at $90.77. Factoring this all together, I believe Medtronic's fair value is estimated at just under $92.87, and this represents a 21.8 upside from fair value. So if we assume no margin of safety, our target buy price would be $92.87. Now, applying a 10% margin of safety, this gives us a target buy price of $83.58, and that's still well above where we are now. A 20% margin of safety would give us a target buy price of $74.29, and we're really just $1 and some change away from that now. So we're really close to that 20% margin of safety right now with Medtronic. These numbers should be taken with a grain of salt. I could be off in a calculation, an assumption could be off, I could be wrong. Always do your own due diligence, but it's hard to deny how compelling Medtronic has gotten at this level. I'm going to be continuing to add to my own portfolio here on the channel regularly throughout 2023. And if you're interested in following along with this portfolio, I want you to consider subscribing, please. And you'll learn more about dividend stocks and some of the strategies that I use. It costs nothing, but helps us out and gets the word out tremendously. Also, please follow me on Twitter at DivGrowthIncome, and let's connect. Thank you guys so much for taking the time out of your day to watch. Until next time, guys, keep investing.